I decoded the formula to trade with no stress. Hey Liquidity gang, it's your man Harrison, and you guys saw my very last video. Your boy was trading stress-free. When others would have been panicking about trade reversing, I was just chilling. I was chilling, stress-free, everything was Gucci. And so in today's video, I'm going to be sharing with you guys 7 tips to trade stress-free. So tip number 1 is entering your setup. Guys, I know it's so simple. It sounds so simple. Just enter. Press the buy button, press the sell button.
Do it! Just do it!
A lot of you guys DM me after seeing my post on Instagram saying that you would have entered there too, but you got a bit scared. Maybe I might lose some money here. Maybe this isn't going to work. So what ends up happening is when the trade idea formulates, they get a bit shook to enter the trade. And sometimes with that hesitation, they then go forth to miss the trade or they catch it pretty late. You're already chasing the markets. And when you're chasing the markets, you are completely stressed out. So this is why when your trading setup actually comes, you should actually go forth and take that setup. Imagine you've been waiting all London session for your trading setup to actually pan out. And then it actually comes and then you miss it. Guys, you are going to be stressed out like crazy. So this is why you always take it no matter what. Take that trade. Take it. And so for me, one of my trading setups is when price tells me that it wants to start heading in another direction, I'll wait for price to return back to an institutional candle before looking for an entry to continue that trend. And so whenever I see that setup, I'm going to take that setup. And then what happens with some people is that because they've missed their entry, then they start chasing the markets. They might enter on something else. What's your business trading engulfing candles when you trade institutional candles? This is why it's so important to trade your setup. Tip number 2, and this coincides with tip number 1, is knowing where to take your profits. Guys, this is another big one. This is something that should be set up from before you actually enter a trade. Because if you know when you're looking to enter and you know where you're looking to take your partials or to close your full position, you can tell yourself, I will not be exiting this trade until when price gets to my profit target. It's either it's going to hit my stop loss or it's going to hit my profit target. This is something I tell myself is I only take profit at liquidity areas. And so for me, it's liquidity or nothing. So this is why it's either going to hit my stop loss or hit my liquidity. And that's one of the reasons I don't move my stop loss so early. You guys saw in my last video that I didn't move my stop loss into profit because I normally move my stop loss into profit when price gets to liquidity. And one thing I like to repeat to myself when I'm in a trade is I trade towards the money. So my profit target is always going to be where the money is. And so that's why I tell myself I trade towards the money. That's one of the biggest reasons for this channel is to help people get confident with trading towards the money. Tip number 3 is using the higher time frames. A lot of people ask me, do you trust institutional candles or imbalances or whatever it is on the lower time frames? There are times I do, but I don't necessarily use those time frames for bias. I use the higher time frames. So for example, if there was a higher time frame institutional candle and a lower time frame institutional candle, I'm always going to choose the higher time frame option. The higher time frame is the parent to the lower time frame. So in other words, the higher time frame is a lot stronger than the lower time frame. So if I see a point of interest on the higher time frame that I want price to turn around at, I'm going to wait for the lower time frames to get to that area on the higher time frames and then look about an entry then. So you always go off what the higher time frames are saying. If I know the higher time frames is pushing up to the upside, I know on the lower time frames, if I can catch a buy entry, it's going to be quite lucrative. So whenever in doubt, choose the higher time frame over the lower time frames. Tip number 4 is use a bigger stop loss. I know you guys want the best risk to reward. I know you guys want to make the most out of the trade, but sometimes we just need to humble ourselves and use the stop loss that the market gives us. If you're looking to sell a currency pair and price is giving you an ideal high to put your stop loss above, put it there instead of trying to squeeze it in a bit more. If you constantly find yourself being stopped out early and then price moving in your direction, the tick's off now, everything's going through the roof. Oh, you know, everyone's against me. They're out to get me. The brokers are stopping me out. You're constantly getting that all the time. Use a bigger stop loss. The risk to reward might not be the best or the greatest or not be the best it can be, but at least you're in a trade and at least you're winning. And once you find some consistency in that, then look about ways to refine it. Tip number 5 is using a smaller lot size. If the sight of, just to say, being in drawdown £100 or £200, whatever it is, 50 quid, even £10, whatever it is, if the sight of being in drawdown is just too much to handle, use a smaller lot size. You'll be a lot more comfortable in that trade. So if you're used to risking 1% per trade and whatever 1% is for you, let's just say 1% is £100, then risk 0.5%. Now you're risking 50 quid and I'm pretty sure you'll be a lot more comfortable losing 50 quid than 100 quid. So if you find yourself stressed out at the value of money that's within drawdown, reduce that lot size. Tip number 6 is backtesting. Family, this is probably one of the best things you can do to have stress free trading. Because if you back test the concepts that you're using, your trading systems that you're using, you're going to see whether they're going to play out or not. So let's just say you tested out trading your trading concepts 10 times, and out of those 10 times there was 5 wins and 5 losses. So you know that when you traded this concept 10 times, you won 5 times and you lost 5 times. But when you won, let's just say you was winning 1 to 3%, 1 to 5%, let's just say keep it at 1 to 5%. So that means you would have gained 25% in your account, just from the wins. You're risking 1%. So that means you would have lost 5% there. So we put those together now, that means you've had 20% gain in your account. When you trade these concepts 10 times, you could potentially get 20% in your account. Guys, you won't even care about the losses no more. You'll be focused on letting the trading concepts play out. And that's the importance of backtesting. Backtesting is all about seeing these things play out over time. And because you've backtested it, you now believe in what you are seeing. And the moment you believe in what you're seeing, you can go forth and do it. I've backtested this so many different times and I know what kind of results it can bring. Now I know that even if I was to lose a trade, the next one's going to come and that's a potential 1 to 5. Make sure you actually give time to backtesting. Give yourself enough time to learn to trade, to learn how the markets move, and then you can go forth and start actioning out what you have already backtested. And the 7th tip, out of everything I said prior to this, guys, this is probably the key one. This is the one that probably trumps all of them. There is no perfect strategy. A lot of folks are waiting for perfection. And because they're waiting for perfection, they miss their entry. There's been a countless amount of times I've missed hitting TP. I've missed entries because of 1 pip or a few pipettes. And first of all, that's okay. Not everything's going to be perfect all the time. Not everything's going to be flowers all the time. It's not always going to go in your favor. Sometimes you're going to miss trades and you have to accept that as a trader. But what you have to do is you have to make sure you position yourself correctly every single day you're trading. Let's just say Monday, they missed your entry. They never retraced to tag you in and then they left. And then prices moved in accordance to the direction you wanted it to move. Look, Monday's gone. That's Monday. But then Tuesday comes. Don't be that person who's still thinking about what happened on Monday. And because we never jumped in on Monday, you're jumping in with them breakouts when you know you normally wait for that retracement. Don't be that person jumping in on those breakouts. Or you can do the complete opposite. You never tagged you in on Monday, price shot up 100 pips or whatever it is. You're all up in your feelings. And then Tuesday comes, you're like, I'm not even trading today. But you normally trade on a Tuesday. And then guess what happens this time? Price comes back, it does the retracement right into that institutional candle. Now mitigation is taking place, but you're nowhere to be found. So this is why you don't look for perfection. It's not going to happen every single day. I tell my mentees all the time, price never did the ideal today. It never did it on Tuesday, but on Wednesday it did. And so that was a beautiful opportunity to jump in then. On Thursday it did. And maybe on Friday it didn't. So you would have had 2 blessed opportunities to jump in, but because you was all up in your feelings, all up in your emotions, you never positioned yourself correctly again. So accept the fact that not everything's going to be perfect. It's not always going to be ideal. And if it doesn't pan out how you wanted, move on. Accept it, move on, and then go again. Those are my 7 tips. Peace.